Okay, here we go with adjusting entries in section 6.2. And I wanted to start by giving you a visual here. So this is in the middle of the textbook. We also pulled up this particular assignment while it was, I forget where it was at in MindTap. Anyway, it's under this week's activities. The Century 21 Accounting Multi-Column Journal, preparing a worksheet in the middle of the stuff here. And here's what we came through in 6.1 where we did the trial balance. We totaled our columns at the bottom. We verified that debits equal credits. And in lesson 6.2 here, we're talking about adjusting entries. And here you can see a little visual on supplies and prepaid insurance and the impact on assets and impact on expenses. Just kind of give you a quick visual. That's where we're heading in the big picture of this thing that we call the worksheet, which has a bunch of different functions that go into finalizing your information for month-end reporting in a sole proprietorship. Okay? So again, just kind of give you a visual on that. So here we go with our lesson here. So we're going to analyze and explain the adjustments for supplies and prepaid insurance. All right. And complete the adjustments column of a worksheet here in 6.2. Okay. So first of all, we need to understand a few things about adjustments. And that is, up until this point, we have just debited prepaid expense and supplies. Prepaid insurance and supplies. And now we're coming back and going, well, we need to make some adjustments for those accounts because they might have changed during the month. All right. Our supplies might have dwindled out. Maybe you have like a storeroom somewhere. Think like a supply room where you have these things on shelves and different types of supplies. And we go to do inventory at the end of the month and we find out we have less maybe at the end of the month than what we had at the beginning. Okay. And these adjustments need to take place in the trial balance, next to the trial balance in our worksheet that we're working on here at month end. Okay. So again, we need to make some adjustments. So when we talk about terminology here, cash paid for an expense in one fiscal period that is not used until a later period is called a prepaid expense. All right. Now, an example of a prepaid expense would be, most common would be like prepaid insurance, where we're paying for, say, our building insurance. We'd be paying that for like a year in advance. And we would use it up 1 month at a time. Automobile insurance, we usually pay that every 6 months. Say we've got a service vehicle for our business. We would only be recording that expense every month as we use it up. So prepaid insurance means we've bought it in advance, but we're going to use it over a period of time. Prepaid expense. Reporting income when it is earned, expenses when they are incurred is called the accrual basis of accounting. And I'm going to show you a quick little video on this. Down here we go. Click to play. I really thought I was going to avoid this ad. Trust me. Accrual Accounting is a system used. And I'm wondering how well you're going to hear the sound on this, but anyway, you can at least read the commentary. By companies to record their financial transactions, regardless of whether a cash transfer has been made. Unlike cash accounting, where a business transaction is valid only when cash is received for goods or services, accrual accounting reports all cash and credit transactions. For example, in April, Joe buys a car from the local dealership for $20,000. The purchase is made on credit with a loan from Joe's bank. The dealership will mark the sale for April, even though the bank doesn't send them a check for Joe's purchase until June. Bank loans, credit card sales, and long-term credit projects are usually paid within a reasonable amount of time. Accrual accounting gives businesses the opportunity to list credit and cash sales in the same reporting period that sales occur,
showing all sales made for a set period. Basically, accrual accounting recognizes when an expense is incurred, not when that expense is paid. For example, an auto dealer purchases a car loan for $10,000 in May and has 90 days to pay it off. The dealer will note the expense in May when he or she purchases the car loan, so that the expense is recorded when it occurs, not when it's paid. The accrual accounting method paints a descriptive financial picture of a business's income and expenses. Accrual accounting is more financially accurate than many other systems, which can lead to better loan rates for a business, making the company more enticing to investors.
Okay, there you go, Investopedia. All right. Accrual accounting. And if you couldn't quite hear that too well, then you can at least read the captions. Okay, accrual accounting. All right. And also, we can generally accept accounting principles require the use of accrual basis of accounting. And here's where we need to compare and contrast accrual basis versus cash basis. Accrual basis means we record the expense in the period in which it's incurred when it happens, not necessarily when we pay it, like the video said. We also call this the matching principle, where we match revenues in the month that they are earned, not necessarily when we're paid for those revenues. And we record corresponding expenses when they're incurred, not necessarily when they're paid. Now, you and I, being individuals, our taxes are based on a cash basis system, but businesses under generally accepted accounting principles operate under accrual basis. Big difference. Reporting income when the cash is received and expenses when the cash is paid, called cash basis of accounting, like I mentioned before. And changes recorded on a worksheet to update general ledger accounts at the end of a fiscal period are called adjustments. So we didn't make any errors. We just got to the end of the period and we realized what we have in the ledger for, say, an asset doesn't match either what we have in inventory or what we actually have left over that's unused in the case of prepaid insurance. Supplies would be our inventory issue. So we need to make some adjustments to some asset accounts because they've been used up and now they're no longer assets, they are expenses. And really all an expense is, it's an expired asset of some sort. That's what an expense is. All right. Here's an illustration with supplies. So here we start out the month with 2 boxes of envelopes. We bought 3 boxes of envelopes. Maybe we had like a big mailer we did or something like that. We bought 3 boxes of envelopes during the month. And we ended up with 1 box of envelopes in our month-end inventory. Well, we started out with 2. We bought 3. Now we had, at some point, we think we had 5. We ended up with 1. How many boxes did we use? Well, we used 4 boxes. And those 4 boxes are no longer in our supplies asset. They now would become expenses in our expense area for supplies expense. So we're moving from supplies, an asset, to supplies expense, which is now an expired asset and a cost of doing business. We had 1 box left. Here's a visual. At the end of the month, using these T accounts, again, supplies expense, it's going to be in our income summary area. And we've been using that as kind of a subdivision in owner's equity, but now we're kind of breaking it out and going, no, that's in our income summary area. Let's keep it over there. All right. We have supplies expense, T account, and our supplies asset, the supplies that we purchased, T account. Now, at the end of the month in supplies, we have a balance. That could be a combination of our beginning balance plus any supplies we purchased during the month, kind of like the previous visual I just showed you. All right, we get to the end of the month and we go, we need to make an adjustment for $530 of supplies used because we went and did inventory in our supplies closet or our supplies room and we found we only had $90 worth of supplies there. We thought we had 620 in the ledger. The ledger is still accurate. It just doesn't reflect what we physically have left over in inventory. So we need to record an adjustment that we used up $530 of supplies. We're going to credit the asset, reduce the asset amount, so it goes down to what we inventoried it at $90, and we're going to debit our supplies expense to reflect those expenses actually being used up during the month. All right. Supplies adjustment on a worksheet. So here we go on a worksheet. Again, trial balance is what we did in lesson 6.1. Now we're over here in our adjustments columns. We're going to put in a credit into supplies and a debit to supplies expense. Very important that we label our account titles for both of our debit and credit items. Okay, so write the debit amount in the adjustments debit column on the line with account title supplies expense. Write the credit amount in the credit column on the line with the title supplies. Label the two parts of this adjustment with a small letter A in parentheses, which I don't think they require of us in that assignment. We're showing we're making an adjustment, which is need to make sure that we actually post this to the ledger in the process. Now, by the way, I need to go back here really quick to my notes and understand that we still need to focus on 4 key questions when we adjust an account. What is the balance of the account to be adjusted? In this case, it was 620. Question 2 is, what should the balance be for this account? 90. What must be done to correct the account balance? Credit it down to what it should be. And what adjustment is made? Well, we're crediting an asset, reducing the value of the asset, and debiting the supplies. And of course, after we're done, every time debits must equal credits. And what's left in the account, obviously, is what is actually on hand. All right. So I'm going to go back and get that down. All right. Then we get into insurance expense. So in this case, for example, we bought 6 months of automobile insurance for our service vehicle. I'm just making this up for $900. 1 month goes by of that 6 months. What's 900 divided by 6? 150, or the same thing it was yesterday. Anyway, so we get to the end of January, we have a balance of 900. However, we used up one of those months of prepaid insurance. So we are going to make an adjustment. We're going to credit our prepaid insurance asset account for 150. We're going to label that letter B, adjustment B, in our adjustments area of the worksheet. And we're going to put in $150 to expense to recognize that 1/6 of that, in this case, my example was automobile insurance, expired during the month. We used it up. And we used it up in order that we could make revenues, back to our matching principle. We used it up so we could earn revenues to offset that. Okay? Our new balance at the beginning of the month, at the end of the month is 750, which would reflect 5 more months, 6 months minus the one that we used up, 5 more months of $150 a month of prepaid insurance that have yet to be used during our business, during our periods here, our months. And we would record that this way. Again, the trial balance is what we did last unit. We're going to credit prepaid insurance for 150, debit insurance expense for 150. Write the debit amount of the adjustments column on the line with the account title insurance expense. So step 1 again, what's your debit entry? Now remember how we did the 4-step process? In this case, we don't have a date, right? Write the credit column on the line with account title prepaid insurance. We're crediting prepaid insurance, an asset. Label the two parts of this adjustment with a small letter B in parentheses. So we have adjustment B. And if we had more adjustments, we would have adjustment C, D, E, and so on. Okay. Proving the columns. So our adjustment columns, rule a single line across like we did with the trial balance. Add both the adjustment to debit and credit columns. Understand we could have several entries in there, and not just our simple 2 here. And rule double lines across adjustment columns to show that they balance, they match. Debits equal credits. What's the concept of how matching expenses with revenue relates to adjustments? An expense should be reported in the same fiscal period that is used to produce revenue. That's our matching principle using, again, going back to accrual basis accounting, recording the expense in the month it's incurred rather than when it's actually paid. Prepaid insurance, if we weren't using the matching principle, we would be recording 6 months of insurance in the month that we paid it, and then the other 5 months we wouldn't be doing anything. And our financial statements showing the health of our business would be very hard to decipher if we weren't doing recording the same amounts every month. See where I'm going with that? It would be really hard to tell, well, why does this one month, how is the expenses so high? Well, that's why. We'd be using cash basis and would throw things off. Again, the 4 questions: what is the balance of the account to be adjusted? What should the balance be? What must be done to correct it? And what adjustment is made? All right. So let's go to MindTap. I'm going to close this out. And by the way, I was just in that preparing a worksheet link here for this week. And now I'm going to go into Working Papers 6.2. And I've been kind of skipping over the textbook sections, but you can always go back and review those in addition to these videos. If you're like, I need to get more of a visual, see what's going on, that's how you could do that. I'm going to go into Working Papers 6.2 and into Work Together. All right. Here is my trial balance for fix it now. All right. And they want us to make some adjusting entries, and they say we have supplies on hand of 75. All right. Well, this shows that I have supplies of 228. Is my ledger incorrect? Well, not technically, no, but it doesn't reflect what I actually have on hand of 75. So what do I need to do to adjust that? Well, I need to take my 228 minus my actual supplies on hand, which is what my supplies account should be. Take 228 minus 75, and I need to credit supplies for 153. Train of thought. So we had a $153 credit to supplies. And according to, technically, we would put an A, mark that as adjustment A. They're not asking us to do that. And to offset that, we would make $153 debit to supplies expense. We're recording $153 used up, 228 minus 75, what our balance should be in the end. By the way, we're going to carry that over here at the end of the month onto our balance sheet, but that'll come later. Secondly, we have value of prepaid insurance is $250. That's what it should be at the end of the month. Well, our balance right now is $375. It should be $250. If you do the math, we're reducing our prepaid insurance by $125. $375 minus $250. We're going to record that as an expense. We're going to credit prepaid insurance. Technically, again, we would put the B parenthesis designation next to that as adjustment B. And down here for insurance expense, we would put 125, and we would also put the B around that. Okay? If we add up our debits and our credits, 278 debit, 278 credit, debit, credit, 125 plus 153, and so down here as well. It looks like we're balanced debits and credits. We put the line above, the double line below, and we are balanced with our adjustments for supplies and prepaid insurance. All right, save and continue. And it's probably not going to grade that for me. Okay, all right. You're going to do one now on your own for Repair World, given a supplies on hand, value of prepaid insurance. Then when you're done with that, you will then be doing a terms review for lesson 6.2. Again, reach out via Google Hangouts if you have any questions. And there you go. Have a great day.